Now we turn to Europe and emerging markets and going through some of the issues that we're seeing on the grain side, as we keep talking about, and we talked about on Friday about the cost of just UN food pricing is going up. So again, we'd like to remind you, please like, share, subscribe. Your support is appreciated. So when we look at the US and Euro area retail sales, the Euro areas come under more pressure, and that's something that's going to continue just based on some of the tightness in the market in general. And while the US has had a nice rebound in retail sales, but now both of them are starting to go sideways. Now the US is going sideways at a higher number. It's a better number, but the Euro area continues to see that pain that is residing in the system. And again, it's going to really weigh on what is that GDP expectation going to look like, especially with some of the issues that remain in the market on jobs, on spending, on inflation. And that's, again, and then the reopening side of just where things sit. Now, when we look at the PEPP and just yields in general as we head into an ECB meeting, you can see that they continue to decline, where the weekly PEP net purchases actually went down again for a second week. So now we had 2 weeks of low purchases. We had a terrible Bund 7-year. And then they're just giving you an idea of where the 10-year benchmark is. So at what point is Lagarde going to have to step up activity? Is it going to be at November levels? Is it going to be at May levels? And this is what we're going to have to listen for when she speaks. Well, when you're watching this, she'll be speaking. But it'll be important to hear, how does she say it? What is she saying? What is the support coming in? Because that's going to be a big driver for what happens with the euro and the US dollar, given how short everyone is the dollar at this point in time, versus where things could happen given the spread that has opened up. Because if we look at last year, when you had the German 10-year benchmark increase, we had a big increase in the PEP purchases. So what is that going to look like? Is there going to be an acceleration to try to adjust that? Now, when we look at Eurozone manufacturing versus services, this is the bifurcation that we continue to see in the market in general on the Eurozone side. Now, services remain the headwind, but with trade and new orders, based on what we're hearing, we're starting to see some of this manufacturing start to roll over. Again, not going negative, just starting to cool off a bit as new orders take a break, toll roads, driving coming down, and starting to see some of this pressure into Germany, Italy, and France, just those three specifically, as we talked about in segment 1. And then when we look at those Eurozone retail sales, so survey was for down 1.2%. It was actually down 6.4%. So again, you're seeing that shift lower, and just based on the pressure that remained in February. Now, February got a little bit better. You had a little bit more of a reopening in the Eurozone level, but now you're starting to worsen again. So Feb could get a little bit of a pop with another fail, depending on how March really closes out. And just based on what we're seeing, I'm not too hopeful. The other side of the German construction. So German construction PMI fell again to 41. Now, remember, anything below 50 is contractionary. But really, when you're between 48 and 52, you're kind of bumping along. Yeah, slightly contractionary, slightly expansionary. But at a 41, you're steeply contractionary. Like, there is a big slowdown in general. And we really, even though we got obviously very low in April, we never got to an expansionary point, which is compounding on itself, leading to, I think, more pressure within the underlying German fabric of the economy, which is why we continue to look at this, because a lot of Europe prices off of Germany. So if you get some of these fears, some of these issues continuing into the market, the pressure is going to continue to mount on borrowing, on GDP growth, and that's going to cause some of these reweights, unless, we can always get more stimulus. But the question then will fall to, well, who is the incremental buyer? Who is the buyer of more German and Eurozone debt? Because everybody's coming to market. So if everybody's coming to market, who is buying everyone's debt if everybody's issuing debt? And this is where we start to come to this conundrum, because with inflation, again, driving higher and all of the leading indicators pointing to this is just getting started, that is where you're going to limit the amount of new monetary policy that can come in, new fiscal stimulus that can come in, again, limiting some of this growth profile. And just taking in and looking at the German orders. So when we look at the factory orders year over year, slightly better in on that side. But when we look at industrial production, it was down by a fairly wide margin. So orders went up, but production dropped. And let's think about that in a bit more detail by using exports, imports. So remember, as I've always been saying, imports are indicative of not only local demand, but also what are your future exports going to look like? Because especially someone like Germany, Germany is an exporting nation. So they're going to import raw materials, semi-finished goods, export finished goods. So as the exports drop, that means that you're going to see a net drop in exports over the next 2 to 3 months. I mean, given you can get some lumpiness in it, but imports have been struggling overall. We've had a little bit of an increase, a little bit of a decrease, which exports will be under pressure. And that's, if we look at the current accounts balance, things tightened up a bit, again, leading to some of the pressure or some of the issues that we think reside in the German market. And then obviously as the German market goes, so goes the rest of the Eurozone. So when we look at retail sales in Italy, something very similar. You could see the big drop in retail sales and industrial production. So industrial production was slightly better year over year, month over month, but that's as we got into January, where February we had another little pop, but things at the back end of February started to slow as we continued into March, which is going to keep things fairly hindered in terms of where does that expansion go. So then let's take it from the perspective of, well, what does gasoline demand look like? What is going to happen at the aggregate level? So more than half of Germans bought more online due to the pandemic. So no, my online shopping behavior did not change last year, was 45%. 39% said, yes, I bought more products online. And then, yes, I bought more products online last year and I plan to continue. So you're seeing more adoption of people purchasing online as they're getting used to the functionality, the abilities, the timing. And that's where we're going to continue to see a little bit less shopping, a little bit less travel, a little bit less just movement as people rely more on the delivery metrics and the delivery backdrop. So let's take this from a different perspective. Let's break it up into pieces. So 73% are planning to buy more clothing online after coronavirus. So when you look at clothing, books, shoes, electronics, everything, when essentially from household appliances north, more than 50% are going to start doing this more online than in person. And again, this leads to the changing consumption patterns that are not only happening in the US, but also in Germany, and not just in Germany, but Europe. And as we've said in previous economy shows, in other parts of the world, we continue to see that online purchases. As we said last week, China had a huge surge of e-commerce during the Lunar New Year, things that are going to continue to remain throughout the system. Now, when we think about the recovery plan, as we talk about some of the problems that reside in Italy and Spain and other parts of Europe, here you can see what they're looking to do in terms of estimates of spending. So Draghi's in position of power. He's looking to right-size try to normalize the economy, get things functioning again. So when we look at digital infrastructure, energy, transport infrastructure, construction, all of these countries are looking to do more and more to try to stimulate the economy through some things that have longevity or a multiple effect on just the health of the economy and driving GDP growth long term, like digital infrastructure, energy. But again, think of digital infrastructure, creating it easier to buy online, easier to do things on an e-commerce level, easier to have Zoom calls or to watch YouTube without buffering, things that are going to be necessary to do more from home, do more, from limiting that net demand on the back end. But while all of this is happening, we have credit standards are tightening in the euro area. And this is something that started at the back half of 2020 and really accelerated into 2021. And this is coming off the back of slowing economic activity. We're getting a rise in yields. We're getting just pressure in general. So, and banks are concerned. They're looking at their bad debt expense. They're looking at how much leverage they have given where the economy sits and how things have really faltered and kind of plateaued at this current level. So they're demanding a higher return or a higher standard for borrowing, whether that be collateral and or just higher rates. So then when we look at some of the leading indicators in general, this is where we start to look at what's happened with coronavirus. So you can see that we've been moving down and really on the end of February into March, again, how things kind of worsened. We actually saw a tick higher in new COVID cases as we came into March, which again is keeping this lockdown index elevated. Now, it's reduced a bit, but it keeps getting extended. And that's where we have to look at what is going to happen in the longer term as we see just a limitation of activity in general, which you can see from public use. Traffic congestion still remains under pressure. And then when we look at just flight departures, restaurant bookings, street purchases in terms of what's happening overall, and then just the general activity still remains depressed and has only weakened through the first 2 weeks of February. And this just gives you kind of that view of what the target rate is. So they got close to the target rate of what they would need to start to open up. And then instead of it going back through that level, it's now gone back up and started to increase and maintain above this 55,000 level. So just to put this into context, further easing steps can follow every 2 weeks, depending on local contagion rates, while an emergency brake was set up to react to hotspots. Remaining restrictions, including the closing of hotels, restaurants, and other non-essential retail outlets, were extended until March 28th. Remember, I was saying I was hoping this was going to get pulled forward? Hard pass. With the next round of talks set for March 22nd. So the initial view was things are getting better. We're on a downward trajectory. It was initially going to be mid-April. Then they said late March. Now with things kind of sticky where they are, now they're saying that they're going to have a meeting every week to figure out what the next 2 to 4 weeks looks like on restrictions within Germany. Again, weighing on just general economic activity, which so far is going to impact all of Q1 to give you an idea of kind of those GDP estimates. So, but where is that pressure going? So Chile has been able to increase their export capacity to try to close some of this gap and soften some of the pricing issues as we saw copper start to reverse a little bit. But what is happening on the copper side? But now Chile is saying that there's talks of another strike, which again would limit the amount of new copper going into the market, driving up prices. Now let's look at Brazil. Well, let's look at Brazil has harvested 67% of their soybeans, and you can see that they are still well off of normal and well off of the peak and average as we see this slowdown, which is putting pressure on the Chinese markets. So then let's turn this to planting. So when we look at planting, they are at 73% of planting and they should be at 97%. And this is an issue that we've seen from just weather in general within Brazil, limiting just how much yield is going to come into the market. There's still time to make it up. I'm not saying there isn't, but this is going to be something to watch to see what kind of pressures are we going to see across the world. So now let's look at soybean harvest pace in Brazil, it's just in terms of PARAN. Here you can see that they're still well off pace. Corn plantings, again, these are two different locations. I'm sorry, the first two charts are a different location versus these two charts. And you can see that there's just a net decline across all of Brazil, as well as Argentina. This isn't just a Brazil-US problem. This is also a Latin American issue. Now, the reason why that matters, so just thinking and connecting into the next segment, grain production should exceed 650 million tons annually in 2025 in China, because China has been buying up a significant amount of Brazilian farmland Brazilian production, because the food security is the problem. So food security has been a top priority, as we've been saying, for China. But 650 million tons is something that they did in 2018. So now they're just looking to get back to normal, as in 2020 yield exceeded 670 million tons despite natural disasters and the disruption. So you're not seeing a huge drive for, so why are they saying something so low? But even with that, China still imported a record-setting corn and wheat capacity. So China will continue importing a critical proportion, but when you think about the 5-year plan or the FYP on agriculture and rural development, it is a huge priority because they're looking to expand China's stock of high standard farmland by 270 million acres, raising the use of mechanic planting, harvesting to 75%, significantly expanding cold chain logistics, and making seed traits and other types of things more readily available. Again, trying to protect and increase local yield to essentially shift things higher in general. And the reason why this matters so much is because there's been a brand new outbreak of swine flu across China and Vietnam this year, which is creating a bigger issue. So the African swine fever is deadly for pigs, obviously not for humans. But the issue is that it's kind of bifurcated as to where these are, because more cases of the virus have been hit in all of the northern provinces and some of the western in Xinjiang and Hong Kong as well. So the latest outbreak is a new variant that is milder but harder to detect, casting doubts over the government goals of achieving herd recovery by mid-year. The new culling in terms of, so Vietnam has had to cull 2,000. Malaysia had its first outbreak, which resulted in 3,000 pigs being culled. This is now projecting or impacting what is going to happen going forward, where the recovery was hoped for the beginning or for the middle of this year, and it's now pushed into the middle and or to the end of 2022. And this is just looking at what's happened with tin, rounding out some of those issues because that's food. Now let's look at the tin side. So when we consider where things are, inventories for tin are at multi-decade lows, just as the cash costs continue to push higher towards 2010, again, leading to more supply chain disruptions, shortages, and price increases that will paint or move into the market in way of higher prices, driving up those costs, which will impact specific entities more than others, especially when we start to look at that local debt sell-off as that continues to accelerate, because we have these fears of what does inflation look like. It's problematic, but it's more problematic or most problematic at the emerging market level as this change in local debt index yields continues to drive higher across the board, not just in the local index, but the issues, and the one that we want to look at is India, because that's the one that's going to be the most susceptible to those issues in general.